What's good, everybody? It's Jonah. Come back at another video. So for this video, I'm going to do the trade or the breakdown for the day, recap of the day for Friday, July 24th, 2026. Now, I do want to highlight that on this day, I did not take a trade. And you'll see in the title of this video, it will say in brackets, it'll say NT, which pretty much means no trade. And I do that because I want to not only have like my own journal for myself that I can refer back to, but also so you guys had the expectation going in that this is going to be a non-trading day. However, just because a non-trading day, that doesn't mean that it's a useless video, right? There's still going to be a lot of important beneficial information for you to learn. And I do this on purpose so that you can see not only the days where I do take a trade and the logic with that, but also the logic and the reasoning for the days where I do not take a trade. And that's to be successful in this industry, you want to, like, just as important as it is to know when to trade, is just as important to know when not to take a trade, right? Because on the days when you're not taking a trade, when it's low probability or when the opportunities don't present itself, that is how you avoid losses, which will ultimately allow you to be more successful in this market, right? So they're both as important. So on this day, a trade was not taken. However, it'll still be a valuable video for you to watch, and you should stick around and watch it in its entirety. So jumping right in, if we look at Friday, July 24th, we see that there's no news, which means it's a normal trading day, nothing to worry about. Now, just to give you more information, right, if we look at next week, we see that next week, right, for Monday and Tuesday, there are no news, at least as of now. So I'll be behind the charts, right, actively looking to trade. And as you see on Wednesday, there is FOMC, right? So you see the FOMC statement happens at 2 o'clock and you have the press conference at 2:30. So my rule of thumb, right, because just as I mentioned, there's days we should be trading and days we are not. To me, FOMC is a day I do not trade because usually price consolidates all throughout the morning and there's usually not an opportunity. And then at 2:30, that's when the massive move happens where FOMC takes out a bunch of traders, right? So usually the gamblers are the ones that wait for events like this. I don't gamble when I trade, so not interested in that. Then my other rule is that I do not trade the day of FOMC nor the days that follow for the rest of the week. So pretty much Wednesday, Thursday, Friday, I would not be trading, and I can give breakdowns for that. Now, for you guys, something else for you guys to know is that the entire month of August, I do not touch price. And the reason for that is because typically price tends to move not as precisely or as accurately as you would expect, and that can result into additional losses or setups that you thought was there probably don't play out normally as they would all throughout the month of August. So entire month of August, I won't be touching it, right? So just giving you guys that just so you know. So jumping in now on the charts, what we first want to do is determine higher time frame bias. So we do that on the 1 hour time frame. We try to figure out based on structure the direction that price is going, either up or down, right? It's just that simple. And we structure to, figure that out. And if price is bearish, right, then we anticipate that it's most likely for price to continue going lower, and vice versa. If price appears to be bullish, then we're expecting that it's most likely to want to go higher. So if we look at the S&P, we're seeing that previously this was the low that was formed that broke this low right here, so it became bearish, and then you see an aggressive push down that left us with this lowest low. Now, prior to this low, what was the most recent swing high that created this low? It is up here. Now, clearly, price is nowhere near at this level, right? Price is nowhere near at this level, and price did not break this low either. So that tells us that right now for the S&P, we are in fact bearish. Even though price is, kind of moving up a little bit, right? It's kind of consolidating a little bit, but it's also slightly moving up, which means if we're bearish but price is moving up, then all this means is that this is just a retracement, right? Because price doesn't just move straight up. Price doesn't just move straight up or just straight down, right? In the markets go in waves. So this move up, we just see it as a retracement, maybe to this fair value gap that's up here, or even this gap up here, before potentially making its way down, right? No guarantee that's gonna do that, but we're looking at price as bearish on the S&P. Now, if we move to the NAS, right, you see that price had a low here, and this low here was cleared with this low, right? So this became the lowest low, and then price aggressively pushed down and made this low down here. Now, if we look at this low, right, obviously price did not trade under this low down here, right? This low still remains intact. So This low remains intact, and the previous swing prior to this low was this high here, and clear as day this high is still intact. So we're still working with this range, and the same idea with the S&P. These are the ranges that we're working in, and price is still in this range. So price is kind of consolidating a little bit, but we see this move. If price moves up bullish, we're seeing that as simply just a retracement, but price is in fact on the bearish side. So higher time frame, we are bearish. So jumping into the 15-minute time frame, we now want to wait for 8:30. So here, this small bearish candle, this is the candle that closed at 8:30, from 8:15 to 8:30. If we look to the left for the previous swing high, this is the previous swing high, right, prior to 8:30. And same idea with the NAS, right? This small candle here is the 8:15 to 8:30 candle. We look to the left of it was the most previous swing high. It is right up here. So now we have our point of interest, right? Our buy side liquidity that we would like to see purge, and then we expect price to go lower. So if we're expecting price to go lower, we're expecting, price to move lower and want to take down the lower targets. So the most obvious extreme low that I'm seeing within this entire price leg, because remember, this, in my opinion, is one entire price leg, because price came down and made this low, and then since then price was kind of consolidated, slowly making its way up. So I see this entire move as one leg, as one move up. So I'm expecting that if price wants to go lower, it most likely will want to target this. So I have this, in my opinion, as my potentially as my final target. And then as you can see, right, that might be the final target, but that don't mean we can't mark additional targets on the way down, right? So you're seeing another obvious low here. You're seeing another obvious low here. You're seeing another obvious low here, which this low, I guess it's not technically the London low, but this is a swing low in London, right? And you're also seeing, this gap right here, which is this low and this candle's high. So you're seeing targets that get formed, and the same idea for the NAS, right? We're expecting it to be bearish, so we're seeing all of these targets that we can mark, right, as potential areas if we decide to take price lower to take partials, right? So we already have the ideal structure and the foundation of a trade idea. Now, just because we have the idea set up doesn't mean that it is going to guarantee play stuff out. This is just what I'm thinking as far as a potential opportunity for a trade, right? So now it is 8:45. So now ideally what I want to see in a perfect world, right, I would like to see price begin making its way up to then clear this liquidity here before we can take price lower to hit all the targets. Same idea here, right? I want price to go up here and then go down so then we can clear everything. So that's what I'm waiting for, right? And in a perfect world, I would love for this low and these lows to remain intact. Now, no guarantee, right? But I would like to see that happen. So now we'll start fast forwarding a few candles. So as you can see, this low does in fact get cleared with this push down, and then you can also see this small bullish candle taps into this fair value gap. So once again, not the end of the world. And the same with NAS, right? You see this low gets cleared with these candles right here. So it's not ideal, but at the same time, it's not the end of the world, because remember, after 8:30, that's when the hunt begins. That's when price begins hunting liquidity. And as long as price still allows us to, because right now this push down here, right, you're seeing this is the low of the session. The brown is New York session. So you're seeing that this move makes the low of the New York session, which we don't want to see. If we're bearish, we want there to already be a low formed, and we want after 9:30 to just push straight up, right? After 9:30, we want to see the push up because we want that to be the fake move up. So if price continues to push down, which it is, right, you're seeing further push, and you're seeing deeper pushes into this fair value gap, right? Price hasn't reached it yet for the NAS, but you're seeing deeper pushes, right? It's not necessarily ideal, but once again, not the end of the world. It can just potentially make the opportunity, if an opportunity presents itself, it could just potentially make it a little less probable. So then we're just going to keep fast forwarding price. And now, okay, this aggressive move, this is 928, 927 to 928. So you see 927 to 928, price taps into fair value gap for the NAS, right? So you're seeing that right now it's not ideal price action, because in a perfect world we would love to have these targets saved and open up. We want it to remain open so that if price does clear our target and push down, we can have that be one of our partials, our areas to take partials, right? So once again, not ideal, but not the end of the world. But remember, um, now you see here this bullish candle. This bullish candle is the candle, the 930 open. As you can see, this bullish candle with this wick down here, this wick cleared the low of this bearish candle. So technically speaking, right, this 930 candle made the low of the session, and the same idea with the NAS, right? The 930 open candle made the low of the session. So at this point, I'm done trading. I didn't take a trade, and at this point, this is when I closed out trading view, because there's nothing for me to do. Because once again, if we're bearish, we want to see as many targets to the downside left open, and we want to see price moving its way up so that on the way down, right, we have a target here, target here, target here, target here, right? We want as many targets to the downside as possible. But if price after 930 open is just pushing down, right, after 930 open is pushing down and it makes the low of the session, then to me it's undesirable. It's no longer like, I'm not looking to trade it because it's not giving me what I'm looking for. And you'll see eventually as price continues a little bit, right? Obviously this was already taken, this fair value gap, and this fair value gap already closed, right? You're seeing that now, right after 930, these were 930 lows. It made the lows, so I'm already not trading no more. But you see, price came up, it pushed up. Why? To clear this high. Like you can see, this liquidity of this high was taken out with this candle. So let me just mark it for you guys. I mean, I'm sure you can see it clearly, but you're seeing it right here. Right now, marking it red because remember, these candles, these highs have buy side liquidity, right? Because these have buy stop orders where traders are anticipating that if price goes above these highs, that it's going to continue going higher. But because we approach the day with a bearish bias, then we're expecting that if price does decide to move up to clear previous highs, it's doing that because it wants to in fact actually push price lower, which you're seeing evidence of it. Price came up, cleared these highs with this move right here, and with this push up, that's when the market was able to enter with its sell orders and effectively push price down. That's why you're seeing this move. Now, if you haven't watched my video from yesterday, highly recommend you watch it, because in that video I talk about the important confirmation that I have been omitting from my trading strategy that has led to me taking many unnecessary losses over the past 2 weeks, right? This pair, once again, we're not trading on this day, but this example shows what I was referring to with my confirmation. So to keep it brief, the three confirmations I was referring to is a break of structure, right? A fair value gap. Well, break of structure, then you want to see displacement, and then you want to see a fair value gap formed within the displacement range. Now, I will show you this example with the NAS. So remember, we're not trading on the NAS or either pair because price made a low of the session before even reaching our point of interest, which was the buy side liquidity, right? So we are not trading. We pretty much closed trading view. I'm just doing this as like a case study so you guys can see an example of what I am now looking for moving forward. So as you can see, price came up and cleared buy side liquidity. Remember, we're bearish, so when we see a push like this, we're not seeing this push thinking it's bullish. We're seeing it from the lens of price actually being bearish, that this is just a liquidity grab. You see price grab liquidity and push down. So when price came up and cleared some liquidity, where was the most recent um where was the most recent structure? Right, prior to this highest move up that grab liquidity, the previous structure point was right here, right? Is this low. So this low gets formed. Now, of course, price comes down and it breaks structure, right? Because price trades under here. Now, the reason why this, as presently constructed, even though it has, if we look at the displacement range, which the displacement range is from the displacement low to the displacement high, right? The last structure point, the last point of structure before the liquidity grab and the break of structure, right? From this range, this low, and I'll, make sure you guys see it, this low to this high, right? There needs to be a fair value gap that's left. And clear as day, we see a fair value gap right here, right? So you see the fair value gap be left. Now, the reason why this is not a desirable opportunity previously, right? I would have taken a trade similar to this because a bearish fair value gap was left after liquidity was taken. But the problem is that price didn't break structure until going under this candle. And as you can see, price tapped into the fair value gap with this wick right here prior to breaking structure. So this would not fit my confirmation for an entry, right? This is how you ultimately end up sifting out trades, because you need to have strict rules so that if price doesn't deliver you what you're looking for, you don't take the trade, right? You want to see a structure break first, and then you want to then, after price break structure, you want price to then go into a fair value gap that was left open. But this fair value gap was not left open because it was already wicked. So there wouldn't be anything for you to trade, right? This is why I need you guys to be careful and to take your time with trading, and for you to be focused and locked in, because this would not meet your confirmation for trade. And the other reason why it wouldn't meet your confirmation for trade is because it does not meet the qualification of displacement. So by displacement, what am I referring to? To me, displacement is an aggressive move in the opposite direction. So of course, price came up clear liquidity. We're bearish, right? So we want to see an aggressive move lower. So if price, after it gave us our first bearish candles, you effectively want to see consecutive bearish candles until price breaks structure. And we are not seeing that, right? Because you see a bearish candle here, then another aggressive bearish candle here, and then you see a bullish candle here, which is almost like a mini retracement. Then you get another bearish candle, and then you get another bullish candle before price finally breaks structure. So to me, I will not classify this as displacement because it's not a rapid move. It can't be a rapid move because price moves fast and then it moves slow, and then fast and then slow, and then fast and then it breaks structure. Like, that's not displacement. Displacement, you want to see one aggressive move straight down where there's no hesitation as far as the direction that wants to go. And I kind of coined the new term. I call it verticality, right? You want price to basically be moving so fast that it looks like it's almost vertical. But if price is going up and it's going bullish, then it's not fully displacement, it's not fully vertical. So a trade like this, let's just say if this trade happened as presently constructed, and let's just say this was the buy side liquidity, if this was our 15-minute high and price got taken here, this would not fit my confirmation. Why? Because this fair value gap was tapped into with this candle here prior to the structure break. So I wouldn't have taken this. Previously I would, but I wouldn't have taken it now. Now this just means that looking at it how it is right now, it doesn't fit our confirmation for the 1 minute time frame. But what I like to do is I also want to check any of the time frames from the 1 minute to the 5 minute to see if there's any other opportunity that fits what we're looking for, right? If we look for the 2 minute time frame, right, we still have the same range, right? We still have this low to this high, right? And then what happens? Once you see the first bearish candle form, you're seeing a second one and then a third one, right? You're seeing the displacement, because once liquidity got taken, now you are seeing the aggressive move. So there's no displacement on the 1 minute time frame, but there's displacement on the 2 minute time frame. And this is the 2 minute low that gets blasted through. Now, within the purple shaded area, is there a fair value gap? The answer is no, right? Because this candle here is not, there's no gap because this wick covers the body. Now, you do see a fair value gap down here, but this fair value gap does not fall within the pink shaded area between the low and the high. It does not fall within that range. Some of it does, but the entire gap needs to fall in it, which it doesn't. So 2 minute, there's no opportunity 2 minute, right? Jumping into the 3 minute, you see the low to the high. After the high gets taken, what are you seeing? You're seeing displacement. You're seeing an aggressive bearish candle, and then another one. You're seeing back-to-back candles. Now, is there a fair value gap that forms? Yes, right? Because this candle down here, as you can see, it doesn't fully form within the fair value gap, right? There's still some gray area that falls outside of this range. So this would not fit the qualifications, right? It doesn't. However, this fair value gap does, because not only do you have a liquidity grab at the top, you have a break of structure lower, and then you're seeing once bearish candles start forming, it forms entirely all the way through the break of structure, and then it left the gap. So, and then, right, so at 3 minute confirmation, if an opportunity presents itself, I would be trading on the 3 minute time frame. Ideally, wouldn't take an entry on the 3 minute time frame, right? Not the 2 minute, not the 1 minute, 3 minutes. And I would pretty much manage my trade and do all that good stuff on the 3 minute time frame, because that's where the entry's at. Now, if we look at the 4 minute, of course, there's no gap, clear as day. And then if we look at the 5 minute, there's nothing, right? No gap, right? So it's literally just a 3 minute. Now, of course, what happens with price? Price just blasts through, right? And it takes, this ain't the London lows, but it's right before London starts. Let's just say for the, let me full screen it also, by the way. So technically this ain't the London lows because this is outside of the green, but for the sake of this, right, it clears the London lows. It clears pretty much the midnight lows, right? So this was the lowest point in the entire day. Price came up, cleared that, and then another previous low right here. Price clears it as well. And as you can see with price never tapped into the entry. So right, yep. So this is important because once again, this was a no trading day. No trade was taken, but I'm showing you guys this so you can see and understand the logic, right? The reason why I was taking so many unnecessary trades was because first and foremost, I was not factoring in a break of structure. So price can leave bearish fair value gaps, but if structure is not broken, it's usually a sign that price does not want to reverse. It's a sign that price will likely want to continue heading in the same direction. That's one, right? There was many of my losses, there was no break of structure that I factored in. Two, you need to remember that your entry for your fair value gap should be within the displacement range. It should be the last leg of price before the break of structure in the opposite direction, right? You have this low and the high, right? You have the high that cleared the liquidity, and then the low prior to the move that snatched liquidity, right? You want to find a break of structure that gets formed there. And then the third element, you want displacement, because I noticed that several of my losses, the main losses came from not having a break of structure, but the other second most important was that I was not fully factoring in displacement, which to me, it's an aggressive move. It's price delivering you consecutive candles going in the same direction, because then that tells you that price is in fact wanting to move in that direction, right? If like this telling me that price is blasting lower, and then look what happens, right? Price is moving rapidly lower, and then look what happens. Price didn't even give us an entry, and it just completely obliterated the target. So because price obliterated the targets, there's pretty much nothing for you to trade, because the trade happened without you, right? Like price just took off. So those were the two main elements. You want to make sure there's displacement, and this is what displacement looks like, because so many times, right, I would hear the term displacement, and I understand, right, I want it to be like aggressive movement, but it wasn't explicitly stated that like you want consecutive candles in the same direction. You want price to be moving in one direction where there's no hesitation or any sort of retracement, right? Some of my previous losses were because I was taking entries where price, would have a bearish candle, and then a bullish candle or two bullish candles, and then a bearish candle, and then a little bit bullish, and then a bearish candle, right? Like that's not displacement, because price is not rapidly moving in one direction. It's moving and then retracing and then moving again. That's not displacement. Now on the 3 minute time frame is displacement. On the 1 minute time frame, it was not displacement. On the 3 minute time frame, this is displacement, because price is certain where it wants to go. It's just price didn't give you an entry and it took off. But once again, price never reached a point of entry, so this was a non-trading day. But I still wanted to give you this breakdown because this is extremely valuable information. This right here, what you're looking at right here, This is the algorithm. This is the machine getting involved, wanting to move price. Now, not every time is price going to, hit the fair value gap. Of course, it won't happen every single time, but it is highly probable for price to do that because if price is moving aggressively and blasts through structure, then, price will have a reason to want to go up to retrace into this gap because it move too fast. And we know in many cases, price doesn't just move directly straight down or directly straight up, right? It usually moves in waves. So this push up into fair value gap is normally the retracement to then continue moving price lower. And we have our entry at a fair value gap because these areas are like magnetic for price, right? Like we expect price to want to make its way back to return before heading in the direction, right? This is the real quote unquote support and resistance, right, of the marketplace. It's these gaps. Um, so I say all this to let you guys know that those are the new elements that I'm looking for my entry. And if price does not deliver all of those qualities of delivering a break of structure, of delivering displacement and then the fair value gap left in the displacement range, then I won't be taking the trade. And if you look back at my trades, right, pretty much virtually all my winning trades had all of these elements, you know, incorporated into the trade, but I was just not fully um factoring that in. And so I guess you can say that I got quote unquote lucky for many of those trades, because then I looked at my losses and I saw that my losses were not factoring these elements, which explains why I lost, right? If I had these as part of my rules, then many of those losses wouldn't have been any trades taken. So if you eliminate many of those losses, then I would have been, of course, very profitable. So these are my new qualifications that I have for my entry. And this is why, even if it's a non-trading day, it's why it's important for you to watch these videos, because then you get to learn so much. You get to see the game that's being played. This is what the market does time in and time out. And this lets you know when it's this signature right here. This lets you know the manipulation and the rigging that price is doing, right? And you want to capitalize on this because then when you do, there is a high probability and a high likelihood that price will in fact tap your gap and just explode in your direction. And if you're on the right side of the market, the right side of the trend, then you can effectively ride the wave lower, and your wins can end up being massive wins where your losses could end up being just standard losses or even minor losses because you'll probably take partials, right? And if price reverses, then you have a mitigated loss, so you still walk away with profit. So that wraps up the video. Enjoy the video, leave a like and subscribe as we're on the road to a million subscriber, guys. So once again, it's Joel, and I'm out. I'll see you guys for the next video.